Good morning, everybody, and welcome to our first webinar for 2022, the Counterpoint Roadshow, titled Is It Time to Go? I think if we're being honest with ourselves, and even amongst the most patriotic of us, if we look back at the last 5 to 7 years, I think most of us at some point would have thought to ourselves, whether we should be taking our money offshore. And I'm not talking 10, 20%, I'm talking all of it. Even though we know when it comes to investments, never to think in absolute terms. As investors and South Africans, we certainly have experienced two very different decades. In the first part of the 2000s, so in the first decade, we received very handsome returns from South African assets, and we certainly saw a reversal of that in the second decade for reasons that are well documented. When we adjust that for inflation, the numbers certainly fell way more in favor of global assets than that of South Africa's. 2021 saw a bit of a resurgence when we look at some of the local portfolios and what they have achieved. And the fact of the matter is, in a couple of years from now, when we look back, the third decade might well offer a very different return profile from what we've experienced more recently in the second decade. Unfortunately, we don't have that crystal ball and we don't know what the future holds. And for that reason, at Counterpoint, we run a multi-style boutique asset manager. We house a variety of franchises or investment styles underneath one roof. And because we recognize that not all investors have got the same investment requirements, nor investment outcomes that they require from their investments. So what we try and achieve is to provide you with high quality and competent products and competent asset management skills, so that when you select and combine certain products, that you can do that with peace of mind. We hope to demonstrate exactly that during today's presentation as part of our roadshow, and we certainly hope that you enjoy today's session. Just before we kick off and I hand over to the first speaker today, we use GoToWebinar as a platform to host these webinars. The first thing that usually goes when you've got bandwidth issues is your sound. So for the best possible experience, please close down all other applications during the course of the session. Then we also provide CPD points. We apply for these at the FBI at the close of the session, and we usually send the certificates when the content gets approved within 2 to 3 weeks from close of the session. We do have a small survey at the end. Your feedback is extremely important to us as a business. It helps us to improve these sessions, as well as in providing us guidance on the content that we need to prepare for these sessions as well. So please do take a minute to provide us with that feedback at the end. And then very importantly, we do have a questions box or a chat box. You'll see that in your navigation pane. Please do post any questions that you have. We do have a very full session today, as we've got 6 speakers in today's session. So if we don't have time at the end to address those questions, we will most definitely get back to you, hopefully before close of business on Friday, as we work through the attendance register at the close of the session. With that, I'm going to hand over to our first speaker, Paul Stewart, who is the CEO of Counterpoint Asset Management. I certainly hope you enjoyed today's session. Thank you.
Thank you, Jaco, and good morning to all our attendees. Your attendance this morning is greatly appreciated, and we know that your time is valuable, so the fact that you've chosen to spend some time with us this morning is greatly appreciated. Just as a matter of interest, we've had over 530 registrations for the event this morning, which for us is a record. So it does indicate that investors, financial advisors have some degree of interest in what we are doing, and for that we are very pleased. Thank you very much once again. We do have several new advisors that we're dealing with for the first time, and I thought it would be worthwhile for the benefit of those people just to give a brief rundown of Counterpoint as a business. There was an article written in one of the financial publications recently about the fact that mergers and financial services businesses and asset managers particularly don't work. But we would disagree with that, and Counterpoint, as it's evolved over the last few years, is the consequence of several businesses that have been merged into one business, one operating unit. And I think it's a function of the type of people that you bring into the business and the stability of the platform that you've been able to create that differentiates the business from success or failure. And you know, from our point of view, we're extremely gratified that the development of the business has been extremely positive, and the multi-strategy platform that Jaco mentioned earlier on is very much taking form and in place. The products that we offer are across both the CIS and segregated investment landscape. We also offer a couple of life wrap portfolios on one or two of the large life company platforms. From a ownership point of view, the company is majority owned by the Merchant West Group, which is one of the largest independent financial services businesses based in Johannesburg. And it's wonderful to have a reference shareholder that is so well capitalized and extremely well managed, and you know, having competent people sitting on the board and helping the business, you know, giving the business guidance, and certainly you know, the ability to continue to grow over a period of time. The business operates both Category 1 and Category 2 operations under its FSP license, but the vast majority of our business is intermediary in nature, where we act as a discretionary fund manager on our range of unit trust funds and segregated mandates on several clients. We have 20 staff operating in 3 offices across South Africa. The majority of the staff sit in the Claremont office in Cape Town, where we're presenting from this morning, but we also have a representation in Johannesburg and a small investment team sitting in Durban. We've taken the decision as a business to focus our efforts 100% on asset management, and the competence and the staff that we house in the business have got a clear focus on managing money. And as a consequence of that decision, we have taken the decision to outsource all non-core administrative functions. And so in that vein, our unit trust administration domestically is outsourced to Sanlam Collective Investments. We've got 2 global funds, one domiciled in Ireland under the Sanlam Asset Management Ireland Manco. We've also got a fund domiciled in Guernsey, and that fund, our Global Value Fund, and that fund is administered by JTC in Guernsey. And we've also got portfolios, as previously alluded to, pooled on the Signia Life License and the 27-4 Life License. The company is audited by Mazars, and we have taken the decision to outsource our compliance to a leading compliance specialist, CompliServe. I think everybody will be well acquainted with CompliServe, and they perform our phase compliance for the business. Obviously, all of the investment management compliance is done at the license level by either Sky or SAMI on the domestic and global portfolios. And importantly, our funds are on all the major linked investment service provider platforms, and they are also on selected umbrella retirement fund platforms. So in terms of access to the portfolios, they are broadly available across the market space. And as of the 31st of December, our business has grown very pleasingly. We thank our investors for their ongoing support and for the significant growth in the business that we experienced in 2021. And the business is now manages 9 billion in assets, and that is fully. There's no double counting in that number. It could be a lot bigger if there was, you know, if we counted sort of multi-manager assets that we look after. So those are fee-earning assets of 9 billion. So that's a very nice business, a very nice platform from which the business can continue to grow. The leadership team at a functional level is really run by 4 people in 4 key areas. I'm the CEO. I think I'd prefer to refer to myself as the Chief Service Officer, because I think the investment management industry is well serviced by many large and highly competent investment management businesses. And we believe that we can differentiate ourselves on 2 areas, one being, you know, unique products that are well managed, but also through excellent client service and distribution capabilities. So, you know, my focus on the business is to try and strive for excellence across these functions, and I've got a very competent and capable team running these areas with me. Brian Pyle looking after the investment team, and it's worthwhile mentioning that of the 20 people in the business, 12 of those staff have actually got investment management responsibilities. So the by far the bulk of our business in terms of its staffing resides under Brian with his team of analysts, portfolio managers, and traders, looking after the investment management and research aspects of the portfolios. Sandy Venn looks after our finance and all the operational functions related to the daily ongoing management of the business. And then extremely importantly, our distribution capability, Jaco Brandt, who introduced the session today, our head of distribution. And we've spent the last 18 months really focusing and bedding down the investment competence under the CIO. Our focus now for the next 12 months looking forward is to reimagine our distribution capability. And I'm extremely pleased to have Jaco looking after that as we gradually rebuild our distribution capability nationally and think about it slightly differently than previously, given the multi-strategy focus of Counterpoint Asset Management. Importantly, we like to think that we are accessible. As a boutique asset manager, we want to be accessible. And each one of these people are merely a phone call away. And we invite you to contact us at any time you want to, and hopefully you will experience the service that we are aiming to offer to our clients. My team and I sat down towards the end of last year to rethink and reimagine the business in terms of what it is that we want to focus on, what it is that we want to be. And I think it's important that businesses relook at these things from time to time. And collectively as a group, we reworded our mission and vision statements and tidied up a couple of areas in relation to the values of the business. And as I've already said, the market is extremely well serviced by many competent investment management businesses. We believe that we have something to say in the marketplace. We believe that we have certain key investment strategies where we have a competitive advantage. And so our mission is to be the preferred asset management company within our chosen strategies. And that also implies that there are areas of the market where we don't believe we have a competitive advantage, and therefore we're not going to compete there. And we want to offer our clients compelling investment propositions across the asset class spectrum. Our vision is to exceed our clients' expectations, and the concept of stewardship is incredibly important to us, really meaning that when we receive 1 rand of our clients' money, we look after that money as if it was our own, as if it was family money. And that's very near and dear to our hearts. We've got a very strong ethic in the business around stewardship. And we believe that we can exceed our clients' long-term expectations by being stewards and delivering exceptional long-term outcomes. And long-term outcomes, realistically in the investment world, are actually 10 years and longer. Because you can have a lot of noise and numbers shorter than that, but we think over rolling 10-year periods with the right skills and the right focus, we can deliver exceptional long-term returns for our clients. From a value point of view, we are all incredibly passionate about investing. It's the one thing that stands out for me when I sit in investment team meetings, when I sit in Exco meetings with my team. The passion that my colleagues deliver is truly inspiring. We strive for excellence. We always prioritize our clients' interests. It's something that we have a strong ethic within the business around making sure that every decision we make puts the clients at the forefront of that decision. Is this in the client's best interests? If the answer is no, you don't do it. As with all fiduciary businesses, we maintain and place the highest levels of integrity at the forefront of what we do. And it's extremely important from a value point of view that all of our staff deliver the highest levels of integrity to the business and to our clients. We take pride in our people. We're a knowledge business, and our people are our competitive advantage. And we invest in their future, and we appreciate the value of diversity and teamwork. So those are the things that are important to us as a business, and they really are our guiding lights as far as how we're going to manage the business going forward, and what your expectations should be of the people and the products and the services which Counterpoint offers to the marketplace. In terms of our selected business model, Counterpoint have chosen the route of active asset management. We are very much active managers. We don't we don't believe that there's anything wrong with passive strategies, but we believe that with the right skills and the right focus, active management can deliver excess returns to investors who are patient through the long run. And, a very important point, we've got a strong focus on process and discipline. The long-term outcomes that you deliver are a function of many short-term decisions. And short-term decisions, good short-term decisions, are predicated on process and discipline. And, we don't necessarily believe that employing, 20 more analysts will give us better discipline or better process. So there's an increasing focus from our business in terms of using data and systems and decision support structures, because we think that is the future. And so we're investing heavily in the area of data and systems and decision support structures to help the business grow into the future and to remain relevant into the future. And all non-core functions, as I've already mentioned, are outsourced to specialists in these areas. We focus on investment management, and we'll let other specialists focus on managing the non-core functions of the business. We are a multi-strategy boutique. Why is that important? Well, we believe that a multi-strategy business can offer a variety of products and services to clients based on the consulting discussion between an advisor and their client. We don't believe that one size fits all, and whether the advisor follows an outcomes-based strategy or an asset allocation strategy or a building block-based strategy, we do have unique and bespoke products and services to meet several of those requirements. We also believe in the idea of a boutique. Smaller managers, empirically and mathematically measurable, do and are capable of delivering better long-term outcomes. And the simple reason for that is smaller managers have a larger opportunity set in which they can add investment alpha. So, we believe that maintaining a strategy operation or a multi-strategy boutique operation is incredibly important. One of the drawbacks of a boutique investment management business is the fact that managers that stay true to their investment strategy do tend to go through periods of bouts of underperformance from time to time, as all managers do. And the diversity of strategies across a range of different uncorrelated strategies does allow the business to remain sustainable, and it allows those fund managers to remain committed to their investment views without the business concerns overshadowing how they manage money. So we believe that it's a very sensible investment framework to have a multi-strategy boutique where unique skills can remain committed to their long-term strategies without concerns around the business. And finally, skills. I believe that we have recognized investment skills in our chosen investment strategies that have the necessary experience and excellence demonstrated over many years, and these are very much non-negotiable items from us as far as a business is concerned. We believe in the power of data and independent thought, and if you look at the strategies that we offer the marketplace, most of our strategies are quite unique and do offer different to the sort of average large manager out there, where we see the offerings becoming increasingly homogenous. And finally, and very obviously, we strive for market leadership where we choose to compete. We think that if you do all the things right and put all the building blocks in place, you can offer market-leading strategies across a range of different unique offerings. 12-month performances to December. We know that 12-month performance numbers are short-term in nature, but I think these numbers, the long-term is made up of a whole range of short-term periods. And the last 12 months for Counterpoint, since we've really been operating as a single and stable investment team, have been extremely pleasing. We've got category leaders in the low equity, general equity, and global real estate categories, where our funds led the categories for the 12 months to December. In the further 4 funds, we were in the top 5 to 10% of the peer group. So the high equity category, the managed growth fund, the value fund, the Counterpoint Global Managed Fund, and the Nedgrid Investments Property Fund. And then our money market fund was in the top 20% of the peer group. So, 9 out of our funds, 9 out of our 15 funds were actually, sort of category leaders. And I think that's pretty amazing thing. It's quite unique. I just looked at the Corian report that was published this morning, And of the 4 key categories being SA equity, global equity, low equity balanced, and high equity balanced, a Counterpoint fund is leading each one of those categories over the last 12 months. Our challenge is to continue to deliver those performances and continue, to deliver on the label of the funds, because that ultimately is what our investors want over a long period of time. I'm also very pleased to announce, and congratulations to Piet Viljoen, but also to the team that supports Piet in the management of his value strategy. The Counterpoint Value Fund won 2 Raging Bull Awards at the Raging Bulls announced last night in the SA General Equity category, both for the straight 3-year return, but also for the 5-year risk-adjusted returns. And I think that's a wonderful sort of sense of what we've been trying to do in the business, and hopefully we can continue to deliver those sorts of outcomes. Interestingly enough, this return was delivered in a market that hasn't really been too kind to value as an investment strategy. So I think that does dictate or demonstrate to some extent the strategy that Piet will talk about later on really has got some value to offer. Just in terms of team and process, as I've already mentioned, I strongly believe that success is the result of consistently good decision making compounded over a period of time. You're not going to get all decisions right, but if you compound consistently good decisions over the long periods of time, you will win. And I always show my staff this little equation, and in the first line there, if you do nothing and compound it over a long period of time, you stay where you are. But if you just make a 1% improvement on a daily basis over the period, the difference in outcome is remarkable. And in time, I believe small, consistent improvements make a material difference. And very much, the discussion with Brian Powell, the Chief Investment Officer, and our investment team is about making those small incremental improvements to process and strategy to inform good investment outcomes to our clients over a period of time. And we very purposefully built our common research framework over the last 17, 18 months. We've got 5 distinct strategies that we offer the marketplace. Our fixed income strategy, where we focus on cash, bonds, and related assets. Daniel King, head of our fixed income business, supported by Rehan Ali and Andrew Dawes in the area of preference shares. We've got our outcomes-based investments managed by Ian Anderson and Richard Henwood, with some additional support from Ray Shapiro on the listed property side. We've got our core business, which is very much in the evolutionary and development stage, looked after by Andrew Dawes and Brian Pyle. Quality, which was really, if you think about quality, it's really simply those businesses that have enduring competitive strengths. We've got both a global equity and a dividend equity fund following the quality mantra. And then our value business, run by Piet and supported by Daniel King, on the global value, worldwide flexible, and SA value side. And value, if you think about it very simplistically, are really businesses that offer investors a margin of safety and a discount to NAV. There are other definitions of value, but those are the sort of key ones we use. And over time, we can build on this framework. We might bring in 1 or 2 additional investment strategies where we believe that we can offer a product or a service with a competitive advantage. But each one of these, in their own rights, will be spoken about during the course of this morning's presentation, and we're very excited about the team that we have in place in this area. So, just to finish off my introduction to the session, as Jaco mentioned, the question, "Is it time to go?" is probably the most asked question that we receive from our clients, and I don't think it's probably different to the question that financial advisors receive from their clients. The answer to the question, I think, is that there's no perfect answer, and individual client circumstances will dictate, what your percentage of capital allocation should be domestically or globally. The other things that one always needs to consider is the perception of safety in global markets versus the risk of the perception of risk within the South African markets. But that's not necessarily true. The South African markets, and particularly, our fixed income markets and any yield-producing assets, offer investors outsized returns relative to similar assets offshore. And so the decision to have one's money onshore versus offshore is a lot more complicated than simply, trying to extract money from the perceived risk of South Africa. And, a final point to consider is that the South African Stock Exchange, represented by the ALSI, is already significantly global. Roughly 70% of the exposure is offshore in one way or another through either rand hedges or resources, luxury goods and technology businesses like Naspers. And there's actually a fairly large exposure to China too. So, if you are going to go offshore, I think one needs to be very thoughtful about how you allocate global opportunities. And I think when you think about offshore investing, it is very much about accessing industries and businesses and sectors that you can't get through your SA Inc. exposure. So thank you very much for listening to me. I would now like to hand over to the next speaker, who is Daniel King, who's going to take you through fixed income. So thank you very much.
Thank you very much, Paul. Just sharing my screen here. Thank you. Thank you everyone for joining us today. I'm just going to take you through some points around the economic backdrop before we cover the Counterpoint Enhanced Income Fund in more detail. Within this short economic analysis, I'd just like to highlight two mega trends, which I think, if you boil things down, most of what we're seeing in the global flow of money today are a result of these two mega trends. The first is this: the explosion that we've seen in fiscal stimulus across the world, but even more so in developed market economies, which has resulted in this sharp increase in government debt levels since the global financial crisis. Now, there's not much information in this chart in and of itself, but it raises a couple of questions about the outlook for global conditions. And the first is, how will this be reversed without disrupting global demand massively? And secondly, what are the implications for inflation and interest rates? Because in the almost 15 years of stimulus, which are potentially coming to an end now, we've become accustomed to developed market central banks providing a backstop effectively to bond yields by purchasing huge quantities of government bond issuance, basically mopping up any excess supply of bonds, and even more than that. So the real conundrum in all of this is the behavior of inflation, which until the pandemic has looked completely under control across most of the developed market universe. And you can see in the US how that's been true for almost all of the last decade until bang, you have now hit a supply constraint in the form of lockdowns, supply chain disruptions, and bureaucracy across the big international trade routes. And actual inflation, as well as forward-looking inflation expectations, which is what you see here, have spiked. Now, the challenge from this point is to separate that inflation impulse into supply and demand drivers, because to the extent that the inflation is being driven by events which are specific to the pandemic, supply side events like the spike in shipping rates, we should actually expect to see inflation ease as trade restrictions are relaxed over time. And you can see here some of the major shipping indices that there is some evidence of these rolling over, at least outside of China, where shipping rates are still rising. But generally, shipping rates are either rolling over or stabilizing globally, most notably here in the Baltic Dry Index. And generally speaking, input cost pressures do appear to be easing. At least if you take the global manager surveys seriously, they do tend to lead actual consumer inflation outcomes by 3 to 6 months historically, as you can see in the correlation here. So why then is the Fed and the Bank of England starting to fret all of a sudden about rates and inflation if we might be past the short-term peak at least? Well, we think that one very important reason is this. In the US, employers are struggling to fill vacancies in the labor market. And the pandemic seems to have created a structural decline in the labor force participation rate. Essentially speaking, there are people who have used the pandemic to bring forward retirement by 1 or 2 years. So we have this transfer of bargaining power potentially from capital to labor at the same time that consumer inflation expectations have spiked, which potentially raises the risk of entering into a longer term wage price feedback loop, which can feed off of itself and actually perpetuate the inflation cycle rather than ease it. So the Fed is starting to see that this risk as more plausible, and already they are kind of pumping the brakes on monetary stimulus. The orange line, which you can see here in this chart, is just the rate at which the Fed's asset base is changing, and the blue line is the monthly issuance of treasury bonds by the US government, with some projections in the dashed lines there. And what you can see from those projections is a widening gap between Fed buying of bonds and the issuance of bonds by the US Treasury, as it continues to run big deficits to fund pretty big government projects that still need to be funded. So historically speaking, that gap between issuance and buying by the Fed means that Treasury yields will most likely go up, which is why that has been happening over the last few months, because the market is front running that. And that kind of discrepancy between the issuance and purchasing of bonds by the Fed could increase Treasury yields by another 100 basis points, quite plausibly, closer to the 3% range, we believe. So before we go any further with that, I do want to spend a short amount of time on what we think is the second mega trend to be watching from a macro perspective, and then we'll go into how we're positioning our fund. The second mega trend is the rapid financialization of the Chinese economy and the more recent fallout in financial and economic conditions in China. So what you can see in this chart is that Chinese corporate and household debt, so just private sector debt, is now significantly higher than most developed market economies, which is pretty abnormal for a relatively low GDP per capita country. And the speed at which that credit expansion has happened in that economy in the last decade is typically actually a red flag for asset bubbles and even financial crises, like the one we're seeing in the excess supply of inventories in Chinese residential markets, for example. So that is proving to be unsustainable, that extension of credit. It's unsustainable in the presence of this structural slowdown in the demand for things like housing in China, which is just associated with demographic changes. And obviously the financial markets are not comfortable with that adjustment to lower growth, given how much risk has been taken within their financial system. But having said that, I think the inflation picture is very, very different in China. What you can see here is that core inflation has not really moved out of line with historical norms in China. In fact, it's still slightly lower than historical averages. So that's important because it means that policy conditions in China could be much looser, supportive even, than what you see in the US. So you can see from these Taylor rule estimates in orange, as well as the 2-year bond yields in dark blue, that while you have these indications that in the US interest rates will probably rise in the near term, there's actually no pressure on Chinese policymakers to do the same at all. So it is a very complex balancing act when you do this kind of work between what are the initial forces at play, but also what is the likely policy response. And then what is the likely market response to the combination of those two things? And where does that leave South Africa? I think that the temptation is always to say, that uncertainty is so high, there's so many moving parts in the equation, South Africa is unlikely to do better than global peers from a market perspective. But I do want to show you some data that I think will challenge that perspective, and some data that perhaps supports that perspective before we start to think about the value in local fixed income markets. Okay, the first is this, the first point, which I think challenges the conventional wisdom, and that is that South Africa's collective foreign balance sheet, which means South African citizens' foreign assets less our foreign liabilities, is now actually in a huge surplus, meaning quite literally that if the rand blows out for whatever reason, the direct first order impact of that is that South Africans on average actually get richer. And that's a function of two things. The first is this great externalization of wealth, which really accelerated after Nenegate, and then the deep local bond markets, which have allowed our government to largely avoid foreign debt at any very significant scale. So 10 years ago, our balance sheet was vulnerable to a rand shock, just like many of our peers. Now it's not. We're not in the fragile five. We're actually anti-fragile to external rand shocks. Secondly, inflation in South Africa and inflation expectations remain really subdued relative to history. And some major indicators of underlying inflation momentum, like residential rental growth, those are very low, as low as 1% currently. So there's no need for our central bankers to panic, is the second point. But what is the most important risk to South Africa's economic prospects? I think that's captured on this chart. We believe that at its core, it's a lack of investment spending. South Africa's capital formation rate is just not at a level which could support long-term growth of much higher than 2.5%. If you compare it to peers, and we do think that private sector investment should be subsidized, as far as is possible at this point, because without investment spending, you don't escape the current growth trajectory, and without growth, you continue to be vulnerable to shocks and disorderly fiscal scenarios. And there are plausible situations where low growth and declining tax buoyancy and bad policy making leads us to these crises scenarios, which we model internally here, where government debt to GDP increases to 150, 200% by 2030. Having said that, under current baseline scenarios, we do avoid that, and debt to GDP is still expected to stabilize under the baseline. But the point is that we are still flirting with that danger, especially in the case of further global shocks down the line. So with that in mind, I just want to focus on the value that we see, despite those risks in the South African government bond market, briefly, and the role of bonds in generating outperformance in the Counterpoint Enhanced Income Fund. So South African long-dated nominal government bonds are providing yields of around 10.5% right now, with inflation-linked bonds providing yields of close to 4%. So that's real yields, CPI plus 4%, which implies that, as you can see here, the market is already assigning a weight to crisis scenarios in which inflation gets out of control. Okay, that's important because the implication is that if inflation remains at more recent historical levels, we're getting 5 to 6% real yields in this market, with substantial potential for capital gain. So the market is already compensating us for that risk to some extent, at least. And if you look at it from a global perspective, you will see that South African yields are an outlier in that respect. The yields on our bonds are significantly above growth potential. And that, to be fair, that can itself present a risk to debt sustainability, but it's also an opportunity for investment. And the point is that these are risks that are priced freely and arguably priced well, unlike developed market bonds, which cluster on the bottom left here, where the central banks have created, potentially created huge distortions. So in the Counterpoint Enhanced Income Fund, we have invested 41% in fixed rate bonds, mostly government issued fixed rate bonds at the longer end of the curve for those reasons. But we are still sensitive to the risks. We highlighted the growth conundrum and the fiscal risks that presents. So we have invested 54% of the fund in very short duration floating rate notes as well, mostly bank and corporate issued floating rate notes. And what we have in this combination, I think, is something that provides a higher income and some potential for capital gains, primarily through those bond exposures. So we really do view this addition of some duration risk as necessary to achieve the mandate of the fund and the primary objectives, which are listed here. So you can see here how the fund has performed since myself and Rayan took over the management of the fund in June of last year and repositioned it in this way. So this is too short a time period to judge the performance of the fund, but I want to make the point that while we have introduced some volatility into the fund, you can see the blue line here, through the bond exposures, we believe it's the good kind of volatility. It's volatility with a strong potential for upside, capital upside, while not only maintaining but improving the income yield of the fund. So we are quite comfortable with that bond overweight. You can see at the bottom of this chart that our gross yield of 7% is largely driven by the government bond exposure. We hope that in the good years we can turn this 7% into 9% to 10% total return on a gross basis with the capital upside that we expect, albeit with some small addition to volatility along the way. So that is where I want to leave it. We believe that we've repositioned the Counterpoint Enhanced Income Fund to be more liquid, higher quality, and with a higher income yield and expected capital upside than when we inherited it. And we do think that this fund is pretty perfect as a comprehensive income solution in a balance fund or a fund of funds context, because it has a comprehensive income asset allocation, and we think an optimal combination of short and long dated income instruments. So I'm going to hand over to Ray to give you a bit of a different perspective on his global equity fund. Ray?
Thank you, Daniel. Just powering up the presentation. Thank you, Daniel. So I manage the Counterpoint Global Equity Fund, and I'm supported by a very able team of other portfolio managers and analysts. Just some background. When we look at global stocks, the whole team is in the room, including the fixed income team, and everyone gives their views. So it really is a team effort in terms of managing the Counterpoint Global Equity Fund. I did take over lead management of this fund at the beginning of last year. Previously, I managed the fund from 2015, which was the inception, to 2016, and then I handed over management to the prior fund manager, and I continued to manage global equities in the dividend equity fund, which also holds both direct equities offshore and local equities. And I have in fact been managing global money at my prior firm from 2010.
Raymond, it's
Yes.
Sorry to interrupt. Have you got your camera switched on?
Apologies, I don't.
There we go, thank you.
Starting with the investment philosophy of the fund, I think the most important and powerful principle in investing is really compounding over long periods. As we know, Paul alluded to the power of compounding in one's efforts and continuous improvement and how powerful that is, and as we know, that very much applies in investing. We really believe, following on from that great businesses compound returns at higher rates for longer periods. This is really the financial hallmark of a great company. It's the definition of a great company, and we believe investors really do underestimate the power of compounding. I think none of us have built-in financial calculators in our brain, and I'm never ceased to be amazed as when you do that to the power of what number spits out the other side. And we believe quality businesses compounded these rates for longer periods, and we believe people undervalue quality businesses. So our goal is to capture these returns from investing in carefully selected quality businesses and continue to hold these businesses. And of course, growth is a very important part of that. One wants to grow cash flows, but purchases need to be made at sensible valuations to facilitate attractive returns. One can't pay over the odds for a business, but one can pay a little bit more. So at the end of the day, quality really endures, and I think this is an often forgotten concept, is that to finish first, you must first finish, and this is the hallmark of a quality company. It survives, it endures, and it thrives. Moving on to the next slide, I think I won't dwell on this too much. I mean, this is an overview, but this is how we see a quality business. What we're trying to do is to buy the best companies, the best possible prices. A quality business really has an attractive product proposition. That means it sells something someone wants and a robust business model. We spend a lot of time understanding exactly how businesses make their money and why they make their money. A quality business has defendable competitive strengths, which results in pricing power, which we think is probably one of the most powerful forces in generating excess return, is ability to raise prices without losing volume. Quality businesses generate sustainably high returns on capital. Over the long term, it's difficult for investors to earn more than the business itself earns on its internal capital. They have a long track record of value creation, and they're able to grow cash flows well into the future. We believe that growth is a sign of health. It doesn't mean they have to be the fastest growing companies out there, but if you're not growing, you're dying. And I think we've seen in the last 2 years of COVID, that being adaptable with a high control over one's own destiny is a very important feature in quality businesses. That was the theory. As we can see, here is the execution. This is the last year's returns from the Counterpoint Global Equity Fund. Yes, it is only a year, but we believe it's representative of the current management of the fund. As I mentioned, I took over management of the fund at the beginning of last year, and the fund has produced strong results in very choppy markets while remaining very robust in periods of weakness. So over 20% return over the last year versus the MSCI World of 15%. And that is a South African global equity average of 4.6. An important point to make is that quality is especially compelling during inflationary periods. I don't have to tell anyone that we're seeing very high inflation rates coming out of especially developed markets, higher than in South Africa, which is quite unbelievable. This is some work done by GMO where they look at 8 inflationary periods going back, and they just show how when one combines quality with value, which is really quality at a reasonable price or paying attention to valuation, you really generate superior returns, especially over inflationary periods. Obviously, this is driven by pricing power, quality businesses having higher margins, which means there's less cost to be passed on as a percentage of revenue, and quality companies also have usually are asset lighter. That means when they have to maintain their assets, it's not as expensive because they're not affected by increasing underlying asset prices. And of course, as mentioned, a valuation discipline is critical. In 7 of the 8 periods, quality plus value outperform both quality and the S&P 500. Again, here we have the execution of what I've just said. So quality plus value, which is the approach we employ. We can see over the last year, the Counterpoint Global Equity Fund has outperformed both all of the MSCI World Value Index, the World Quality Index, and for good measure, I put in the World Growth Index as well. So valuation cognizance provides resilience in what we see is quite unpredictable markets. Onto a very important, I think, part of investment management, and that is portfolio construction. It's often forgotten about. We tend to focus on individual stocks and broad ideas, but portfolio construction is absolutely critical, and we really believe that one has to diversify, but with a difference. So there's a few features here that I just want to highlight, and that is our tobacco positioning, which is going to become apparent in the next slide. We've got 7.6% in tobacco, and then when we look at technology as a percentage of the MSCI World is almost 23% of the MSCI World. However, lots of well-recognized technology companies have been reallocated to other sectors such as communication services, which is where Facebook and Google sit, and consumer discretionary, whereas companies like Amazon and Shopify sit. So I've just created a new weighting, which I call broad technology. So if I reallocate a lot of those companies back into technology as we understand them, technology is really over 30% of the MSCI world, and we own almost 18%. We've got an 18% weight, so it's not 30, but it's still pretty high. And the companies we own really differentiate us. SAP is a very stable company, well entrenched, and Booking.com, as I'm sure everyone is aware of, it is effectively a technology company, but it's got good exposure to the recovery in trade. We've got Meta, Google, which are well known, and Taiwan Semiconductor, which is semis. In addition to that, we have a heavy weighting in what we call investment companies. Berkshire Hathaway, of course, very well known, in Brookfield, and these companies are very stable and really run by proven capital allocators, and really companies that have access to opportunities that we would struggle to access in a listed space, and we are very comfortable with our holdings in these companies. Moving back to the tobacco versus technology companies, we can see in the next slide that tobacco has provided a very strong hedge against the recent market weakness, specifically in technology and growth companies. So if we see in the shaded space there, we can see there are a couple of lines going the wrong way, that is technology and growth, and quite amazing is how tobacco has really lifted off. And owning tobacco, a decent weight in tobacco, and not that we don't own technology and growth, but we do, has provided a very good hedge. So tobacco gives you pricing power during times of inflation. It's incredibly good value, and it's a diversification tool. We can see tobacco has done very well over the last year. Who would have bet on that? Beating technology handily, and the MSCI World and the Growth Index. Now, if I carve out that period of the last 2 months of when this market inflection point happened, we can see that tobacco, of course, did very well, but the fund is in fact positive, while the global equity peer group is negative and growth is also negative. So the fund has demonstrated good resilience due to purposeful portfolio construction. The prospects, in a nutshell, we believe our multifaceted, diversified portfolio construction approach provides a very strong foundation. So before taking advantage of opportunities, first make sure that your foundation is strong, which we believe it is. Owning companies with pricing power, which is the hallmark of quality, protects us from inflation. And we believe there is significant pent-up reopening demand, and this is being underestimated. It doesn't mean we're betting the house on this, but we've got decent exposure to this reopening demand. Booking.com mentioned was one of them. We also own a number of airports, which have done very well for us and are continuing to gain strength. We do believe there are opportunities starting to emerge from the recent tech wreck, and we're watching very carefully. And we think there are opportunities, and there will be opportunities to buy quality companies at reasonable prices. In addition, we shouldn't forget emerging markets have been incredibly weak over the last 12 months and are starting to look attractively priced. We haven't had material exposure to emerging markets, but we're looking at this area very carefully. At the end of the day, however, our principles are timeless. Stock picking exceptional businesses at attractive prices underlies absolutely everything we do. We're not trying to get in and out of the hot sectors. We are trying to stock pick the best businesses we can at the best prices. Diversification across business models, cyclicality, company life cycles, and potential scenarios such as COVID rebound and recovery and interest rates and inflation. One has to diversify. To bet on any of these one things is dangerous. So to just have companies at the growth stage of their life cycle can be dangerous, as we've seen recently. And just to only own cyclicals or only own defensives is so dangerous. But we look for quality across all these different buckets. We employ a long-term future focus. The future is where returns live, not in the past. And structural changes are always underway, and when one looks to the future, one has to take these structural changes into account. Patience is incredibly important. When one tries to market time based on the latest macroeconomic forecast, You can risk breaking the chain of compounding by getting in and out of things, which we believe is really the cardinal sin of investing. And we believe opportunities really exist where there's a disconnect between perception and reality. So as far as possible, we try not to sit in front of our screens all day and actually talk to companies, find out what's happening in the real world. And when we're allowed to travel as much as we can to see what's happening across the globe, which we believe really gives one an edge. So the fund mission, to really summarize, is quality is the foundation, and then off that we balance value and growth. Quality is neither value nor growth. Those are inputs into a valuation equation and view, but quality just provides underlying strength. So we want to capture the full benefits of compounding by investing in a diversified portfolio of quality growing companies and holding these companies for an extended period and making sure we purchase them at attractive prices. And with that, I think I will hand over to the next presenter. We're very excited. I will say in closing, we're very excited about this fund. We're seeing a lot of opportunities out there. Thankfully, we've been able to avoid much of the wreckage from tech, but we are certainly not dogmatic in terms of the companies we own, and we remain flexible. All we insist on is buying the best companies at the best prices. So thank you very much for your attention, everyone. Jaco, are you there?
Yeah, thank you very much, Ray. Thank you very much, Ray, for that. My name is Richard Henwood. I co-manage the Counterpoint SCI Global Property Income Fund with Ian Anderson under our Pay As and Grows franchise. And today I just want to give you a little bit more information around the fund, how we positioned it, and sort of what we see as the sort of short-term to medium prospects from this point going forward. Just to give you some high-level details or key details of the fund is listed in the Global Real Estate General ASISA category. It is benchmarked against the GPR 250 REIT index, measured in rands. And the investment objective is to obviously provide long-term capital growth with a high level of, with a level of risk associated to an aggressive risk profile. So you're looking at a 5-year timeline plus. Special note is the fund was previously called the Bridge Global Property Income Feeder Fund and was restructured from a feeder fund to a direct property fund in June 2021. Why do I mention this? Is because actually now the fund is and will pay on a semi-annual basis distributions to its unit holders, which makes it quite unique in its peer group. A lot of the other funds in the peer group are feeder funds or fund of funds which don't naturally distribute any income. Just looking back at 2021, obviously a very strong year for global listed property. The GPR 250 REIT index in US dollars produced a return of 35.3%. This was versus sort of the MSCI World, the equity index producing just under 22% in US dollars. The GPR 250 REIT index was obviously obviously a very disappointing 2020, largely affected by COVID-19. And that sort of price increase or recovery we saw in 21 was largely on obviously global GDP returning, obviously on the back of COVID vaccines being implemented and reduced COVID restrictions in many developed and emerging markets. What we also saw last year is a rise in inflation, and obviously that's been mentioned already by Daniel and Ray. And this was largely sort of unexpected inflation. I think it was a lot higher than most expected. And this is on the back of obviously consumer demand, pent-up demand, as well as constrained global supply chains, which are still sort of being impacted by COVID-19 in certain areas around the world. And also seeing a large jump in energy prices. A lot of us were seeing the stories around the gas prices moving higher in the UK and the impact it was having on many of the gas providers there. What this higher inflation has brought is also very much now large uncertainty around the speed as to which the Fed and its other sort of central bank peers will do when it comes to the monetary stimulus they have provided, obviously going into COVID, and how quickly they need to withdraw that, and how how quickly they might need to increase interest rates to fight off against inflation or control inflation as best they can. Just looking again at that large return that we did get out of the GPR 250 REIT index last year, there was significant dispersion in those returns by region and sector. So just moving forward, we'll look at that now. Looking at the performance last year, first on the left-hand side by region, the North American REITs were the star performers. You had an average return of over 40% coming out of US REITs, and that was largely followed by Africa, Oceania, and Europe and UK, who all produced sort of fairly good returns, positive returns, but nothing like we saw out of the North American REITs. The big underperformer there in the sort of clear laggard was the Asian REITs. And if we just think back to, and Daniel mentioned this, the sentiment around Chinese property, the huge debt bubble, I think that's obviously had quite a significant impact on investor sentiment to the region, Asia, being China, Singapore, Hong Kong, and a few other islands there. Looking at the sector performance on the right-hand side, again, industrial was the clear winner. Industrial in the GPR 250 REIT index also includes your sort of logistics warehouses, your data centers, as well as your self-storage. So all sort of clear COVID winners in 2020, continuing into 2021 with strong capital price appreciation. We also saw good returns out of residential and retail, largely on sort of early recoveries to COVID-19. And obviously continuing to be relevant in the sort of new world post-COVID-19. But the clear underperformers were those sort of sectors like healthcare, office and hotel or leisure, still being impacted by COVID-19, somewhat restrictions, and obviously sentiment to these as to how the long-term trend around their use might obviously play out as COVID-19 dissipates and we move forward from that. Just looking at the positioning of our fund, the pie chart on the left shows by region how we are positioned. You can see obviously more than 3/4 of the fund is actually in North American REITs, and that is largely your US REITs. It is by far the largest and widest and deepest REIT market in the global sector, on the global sort of opportunity set. We've also then got 9.4% allocated to UK REITs, Europe at 6%, Australia at 4.2%, and a cash position of 3%. A bit higher than normal, but we were sort of, we did manage to liquidate a few positions towards the end of last year. Didn't participate in the sort of the December rally that happened, chose to rather sit on the side, wait for those prices to come back, and we will deploy that cash now as we've seen the prices come back in January. How do we compare versus the benchmark? And that's on the right-hand side. You can clearly see we are overweight Europe and UK REITs, sitting at about 7.5% higher than the benchmark. And that's largely due to the massive underweight we have at the bottom of that stack to Asia. We actually took the decision a few years ago to exit all Asian REITs, largely around sort of grey areas around the REIT structures in those sort of jurisdictions, as well as governance issues, and just the fundamentals don't necessarily stack up versus the other sort of regions that we can invest in. So we've taken that sort of allocation and sort of put more towards Europe and UK, which we are more familiar with and more comfortable with, and believe there is more sort of upside in those sort of harder currencies that we get exposure to. So yeah, we have zero or no direct Asian exposure in our property fund at the moment. And just to complete that stack, obviously slightly overweight North America, slightly more Oceania, which is Australia, and very much neutral Africa. There is actually very little African exposure in the GPR 250 REIT index, and we actually have none in our fund. Looking at our fund positioning from a sector point of view, what I like to show on the pie chart on the left-hand side is that it's a very well-diversified portfolio across many different property types. Some of your more traditional and then some of your more alternative property types that you get exposure to in the global markets. The biggest weight is to residential at 23.4%, followed by select retail at 18.8%, logistics warehouses at 16.8%, and office at 10.8%. You can also see we have small allocations to your likes of your towers and data centers, self-storage, diversified healthcare, and that cash position that's sitting there. When we look at that compared to our benchmark, the 250 REIT index, how do we compare versus the benchmark? Residential, we are overweight. You can see we are sort of 4% over the benchmark there. We feel very comfortable with the valuations, and we do feel that there is potentially more short-term upside in those earnings, as well as sort of capital growth, as residential will be, one of the first property types to benefit from higher inflation due to the shorter-term nature of their leases and the mark-to-market that comes through. And just seeing data more recently about asking rents in many of the US cities over the last couple of years, there's definitely been a large spike in the asking rents in the US in the second half of last year, and almost pretty much follows the inflation curve and the projection of inflation as it's sort of gone up during the second half of 21. You can also see we are still slightly overweight retail. Our retail is very select at the moment. We are sort of more heavily weighted towards the convenience, grocery-led retail sectors in our retail bucket. Those have proved to be quite resilient and relevant during COVID-19. You can also see we also are just slightly underweight industrial and office. Office, we still obviously wait and see how the long-term impact of COVID-19 might have on the office use, post the pandemic, and how many people still continue to work from home, or how many people will sort of move on to more flexible space utilization. So that is a wait and see. I don't think anyone has the answer for that yet as to how the office sector will be truly impacted by the COVID-19 pandemic. The one thing to highlight is our sort of clear underweight to the healthcare sector. It is a sector that we are watching and are very sort of keen to see how it plays out. Obviously, with the aging demographics of global population, it is a sector that is going to benefit over the medium to longer term through higher natural demand for the product and the product types. So it is a sector that we are likely to see us sort of close, get back to sort of more neutral, and potentially go overweight. But we'll do that as sort of the valuations allow for. We do think residential will catch a more upside in the short term, but medium to long term will maybe sort of transition back to more healthcare and increase that sort of weight in the portfolio. Just stepping back now after looking at both the sector and our region exposure, one of the big debates at the moment, and people talk to value later, is value versus growth, the two different factors. Obviously, growth has had a massive and stellar run over the last, let's say, 10 years, since the financial crisis, even more than 10 years. And the big debate now is whether that sort of momentum switches and goes behind your sort of more value-oriented stocks and sectors. And so looking at our portfolio, I did show you it's obviously well diversified across the different sectors, but I believe we've also taken more of a barbell approach to value versus growth within the different property types, and we are pretty much evenly spread between the two. So on the value side of the bucket, what I deem as sort of value property sectors is your retail, office, healthcare, and diversified sectors, all sort of trading on reasonable valuations and reasonable multiples, all still projected to show some good growth, largely a recovery in growth from sort of COVID-19 or pre-COVID-19 levels, versus on the right-hand side, the growth bucket, or what I've deemed as growth property sectors, being your logistics, warehouse, data centers and towers, self-storage and residential, which are all trading on relatively high multiples or elevated multiples, but have got strong real growth coming through in the short to medium term, which probably warrant those valuations. But we're sitting with the sort of fairly even split between value and growth, and we don't necessarily have all our eggs in one basket. And so we feel we are sort of appropriately spread between the different sectors, as well as what I would deem the value versus growth sort of buckets. Just looking back at some historical information and trade performance and market performance, and the big topic around inflation. The left-hand chart here shows US inflation since the 70s. and thinking now that actually is 50 years of information or data that we've got here. That's how far we've moved into the new century, 2022. So, back in the 70s and 80s, the US inflation rate, it spiked above 10% on 2 occasions on an annualized basis in the 70s and 80s. And what this chart is showing is, and it's graying out, the gray components of the chart are showing what is deemed high inflation periods. High inflation in this chart is above 6.9%, which is 1 standard deviation above the average. And then moving forward through time in the 80s and the 90s, as we saw that US inflation rate come down, those areas sort of depicted in green indicate sort of inflation periods would have been sort of labeled as moderate, where inflation is averaged between 2.5% and that 6.9%. And then more recently, in the more recent past, the areas that are sort of just white or not shaded sort of indicates periods where US inflation has been below 2.5%. And you can see for the large majority of the last 10 years, US inflation has been below 2.5% on average, and that's been deemed a low inflation environment. So now looking at, what did the returns of US REITs versus their equity peers and measured by the S&P 500 equity index, how did they perform relative to each other? So that on the chart on the right-hand side, the first stack on the left, that is the low inflation environment. So that is sort of what are the returns done during those periods of low inflation over the last 50 years. And you can see, and it's not too unexpected, that US REITs did underperform S&P 500 during those periods. The returns were still fairly good. You were getting close to 10% on your US REITs. But US equities measured by the S&P 500 were getting sort of towards 12, 13% on average during those low inflation environments. The stacks on the right are sort of more interesting and also not unexpected. During moderate inflation periods, those US REITs outperformed the US equities measured by S&P 500. And obviously during high inflation also did outperform, but you can see both asset classes didn't perform as well as during moderate inflation, where I think the market is more comfortable, as inflation comes through and how that affects companies. I think in high inflation environments, it's quite unsettling as to the impact it has on obviously the market as well as the fundamentals of the companies that trade through those times. So the evidence is there that the market appreciates that US REITs or REITs as a whole, being landlords of obviously of property, benefit from high inflation environments because leases are generally contractually linked to inflation, as well as your short-term leases sort of produced by the residential landlords, for example, do mark to market more often and therefore will benefit from rising asking rents through higher inflation periods. So the market does appreciate the benefit of REITs in higher inflation environments. Also, just looking back at some past performance of global REITs, this chart on the left-hand side has been produced by the MSCI Index Group. This shows the MSCI World REIT Index, which is a REIT index very similar to the GPR 250 REIT, which we follow as our benchmark. And this plots the sort of the total return performance from December 2006 through to December 21. The blue line indicates the MSCI World REIT Index, and the yellow line is the MSCI World Equity Index. And so, following on from the last graph, where we do know the last 10 to 15 years have generally been low inflation environment, we can, and as expected, the equity market has outperformed the US REIT market. But just looking at the right-hand side is just to show those annual returns. Obviously, we do show on an annualized average basis, the returns are relatively high out of these two growth asset classes, but it does come in lumps, and it's not as regular as we'd like it to be, but it does show that this growth asset class has potential to produce strong returns at certain times in the period. And I think what I'm trying to get from this is trying to time the market is a bit difficult. You want to be in the market at all times to experience the sort of returns, the return potential that comes out of this. But it will be interesting to see if we look back at this graph on the left and let's say 2 to 3 years time, And if we have had the higher inflation environment that many are expecting, or many of the economists are expecting, to see if that blue line has sort of closed that gap and outperformed equities over the next 2 to 3 years as we go through that environment. So just in closing, and just an outlook statement for 2022, I think what I've tried to show you, and sort of the evidence shows that global REITs do offer inflation protection. We do obviously, are aware that they do benefit from rising inflation and what it does for their revenue streams. And also the market appreciates that. So the market has rewarded REITs in the past by capital appreciation that has come through on the listed global property prices. So, whether inflation occurs, how much, we do know that REITs should benefit from it. What we're also expecting, unfortunately, is a rising of interest rates. The Fed has to react to this higher inflation. How quickly and how far do they move those interest rates in the US, and how far do the peer group follow the US? I think this is largely going to be led by the Fed. We don't know. And unfortunately, that is going to cause some short-term volatility. So we do foresee some volatility through 2022. I think January has sort of been evidence of that already, as the market tries to reprice how do we value securities or growth asset securities in a higher interest rate environment. And there's no doubt that that will create some volatility in the short term. So we do expect volatility this year. But looking at earnings, we do expect strong earnings growth to still come through from large components of the REIT sector. That growth bucket of property types like your warehousing, your self-storage, your data centers, your towers, all large tenant demand-driven earnings growth is expected to still come through in 2022. As well as we're going to see from that value bucket that I tried to describe earlier, a large earnings recovery. So all in all, strong earnings growth to come through in the 2020 year. So what I've also then tried to just show you guys today is that, our property fund, we do believe is a well-diversified portfolio. It is sort of spread across various sectors, and it is spread across what we deem sort of your value sectors, which are trading on reasonable multiples, and your growth sectors, which are trading on elevated multiples, but with strong growth potential, which we think is real and will come through. And just as a closing point, I think I did speak around the volatility. I do think the volatility that we expect this year does create an opportunity, though, for investors who have been sitting on the side, who would like to add global listed property to their portfolio as a form of some inflation protection. It does provide the opportunity to potentially get back into the market or to buy at sort of slightly lower prices. I think January's sort of performance to date, or performance, has shown that that opportunity does come. And with that, I would like to hand over to the next presenter and thank everyone again for their time this morning. Thank you. Ian?
Thanks, Richard. Good morning, everybody. I'm going to be changing tack somewhat in terms of my presentation. The previous presenters have all tended to focus on just one single portfolio. I'm going to be looking at the suite of payers and growers funds, looking at it in the context of retirement income planning or financial planning. Unfortunately, I've only been allocated 20 minutes. I can talk on this subject for hours. So what you're going to get today is just a brief overview of some of the key or core issues within the suite of portfolio, within the Payers and Growers suite. What I am going to do, though, is during the course of next week, I will be hosting a series of online workshops. There are 5 in total. If you would like a little bit more information, if you're not already on the list of attendees or invitees, please give either Yaku or Roberto or myself or even Richard a call, and we'll make sure that you attend one of those workshops where we're going to flesh out some of these ideas and look at how the Payers and Growers suite can be used in terms of building a retirement income plan. So I'm going to start just by reintroducing everybody to the P&G suite of portfolios. We've split it up in terms of local and offshore, and then in terms of multi-asset strategies and our property strategies. And when we talk about local and offshore, we truly mean local and offshore. Our local portfolios have just local investments. They're JSE listed investments. Our offshore investments are entirely offshore, and there's typically no overlap in terms of local and offshore. There's no blend of the two. And I'll come to the reasons why we actually do that. There's a very good reason why we do that. So in terms of our local multi-asset strategies, we have our stable P&G fund, which is a low equity multi-asset fund restricted to 40% exposure to equities. We have the managed P&G fund, which is again a multi-asset fund, this time in the high equity category. So again, a restriction on the equity we can hold, but it's obviously significantly higher. Both of these portfolios are Regulation 28 compliant. And then within the local market, our property strategy is done through the Nedgroup Investments Property Fund. In terms of our offshore portfolios, we have the Counterpoint SCI Global Managed Growth Fund, and then, as Richard has already pointed out to you, the Counterpoint SCI Global Property Income Fund. I'm not going to spend a heck of a lot of time this morning talking about either of our two property strategies. Richard has already spent a lot of time on the Global Property Income Fund, and Nedgroup, I'm sure during the course of this year, will do a number of sessions with various advisors on the Nedgroup Investments Property Fund. I do just want to emphasize again a point that Richard has already made around the fact that the two offshore funds have converted from fund of funds to direct security funds, and as a result of that, they are now actually paying distributions. Both funds have already paid 2 distributions. The yields certainly are not as high as what you would get in the domestic market, and that's just purely a function of where interest rates and bond yields are globally. But importantly now, from a retirement income planning perspective, these portfolios are not just there for capital appreciation or for diversity. They are also there now to provide some level of income for our investors. So those of you that have used a combination of local and offshore in your retirement income plan and have relied almost exclusively on receiving that income from our local portfolios, you're now going to get some income from the offshore portfolio as well. So why do we have this separation of local versus offshore? Why do we not follow many other asset managers who typically blend the two? And so when you buy into any multi-asset strategy in South Africa, typically you're going to get a combination of local and offshore. And we don't believe that a one-size-fits-all model is the right model. Every investor has a different appetite for risk, has a different appetite for how much local they can have, has a different appetite for how much global they can have. And that's based on a number of factors which are unique to each and every investor. We don't know whether you're in an accumulation phase or a decumulation phase. Now, our view is that it shouldn't really make a big difference, but typically people have a different attitude towards risk and income requirements in the accumulation and decumulation phase, and that probably needs to be factored in when an advisor sits with a client and builds up a retirement income plan. The regulatory environment will also determine just how much offshore you can. If you're in a Regulation 28 compliant environment like a retirement annuity or a preservation fund or a provident fund, well, then you're restricted to 30% direct offshore. You could add another 10% African exposure to get it up to 40%, but by and large, you are already at your 30% is your limit. Clearly, when you're in a living annuity, those restrictions fall away, and then the portfolio can be constructed completely differently. A client's income and growth needs obviously change, and each client has a different income and growth need depending on their lifestyle, changes in their lifestyle, how much money they've been able to save, have they dipped into their savings at any point in time. And then a very, very important factor is tax. In a local regulated environment, it's very easy to avoid tax, and so having a lot of money in a locally focused fund tends to generate high returns simply because there's no tax leakage. However, the minute you introduce offshore, there is some tax leakage. You know, between 15 and 30% of the dividends that you receive from your offshore investments will be withheld, and you know, there are also other tax implications that need to be considered. So as a result of that, at Counterpoint and specifically within the Pay As and Grows portfolios, we construct them in such a way that the financial advisor and the client are able to choose the optimal mix. Now, I mean, it's worth pointing out, and Paul has already alluded to this fact, even though we would consider, for example, the managed PNG fund to be a domestic-only portfolio, it's very difficult to avoid having some offshore exposure by investing on the JSE. So if you've got 65% exposure to domestic equities, and I use that term loosely, domestic, you will have a fairly hefty chunk of those revenues, or the revenues from the companies that you own, generated outside of South Africa. And in fact, some of the businesses that we own within our domestic portfolio actually derive no revenues whatsoever from South Africa. They are pure rand hedges, but nevertheless they are listed here on the JSE. In fact, I think the last time we looked, which was just a little while ago, about 35 to 40% of the revenues from our domestic equity portfolio are actually generated outside of South Africa. So even in a domestic portfolio, you are going to get some offshore exposure. But that does mean the fact that we have this very focused local portfolio and very focused offshore portfolio, it does mean that comparisons with the peer group can be quite different, where that offshore and local is often blended. What I've done here is just have a quick look at the performance of the managed PNG fund, the global managed growth fund, and then the managed PNG's funds peer group. It's a data series that I get from PlexCrime that basically just looks at the average performance of that particular category, being the multi-asset high equity category here in South Africa. And you can see that a domestically focused portfolio like the managed PNG fund has underperformed the peer group, and obviously one that is almost entirely offshore has significantly outperformed the peer group over the last decade, over the last 10 years. Now, yes, in the case of the managed PNG fund, we have been able to close the gap on the peer group, and that gap is continually closing. But I think, you know, if you want to look at how well the strategy has been working relative to the peer group, it's probably worthwhile to take a blend of the managed PNG and the global managed growth fund and compare that to the peer group. And that's what I've done in the next slide, where I've used two blends. I've used a 70-30 blend and a 75-25 blend, 70% managed PNG, so 70% domestic, 30% offshore, 75% domestic, 25% offshore. And you can see the returns from those two blended portfolios have been able to consistently outperform the peer group. And the reason for that is both of those portfolios tend to be fully invested in growth assets throughout the cycle. And you know, that leads me into the next slide, which is, you know, what we are trying to do within the Pay As and Grows suite, the types of portfolios that we're trying to construct. And we refer to them as income efficient portfolios, and these are ideally suited for clients both accumulating and decumulating their savings. So whether they are working towards retirement or they're already in retirement, these portfolios are ideally suited for that particular investor. As I've mentioned, in order to maximize the total return through time, we keep the portfolios fully invested. That does mean that there is going to be volatility because we have the highest possible exposure to equities and listed property throughout the cycle. We don't put on any protection. We don't go into riskless assets because that means that you're going to sacrifice your longer term returns. We have a buy and hold strategy in these portfolios, so there's very little portfolio turnover, and through that buy and hold strategy, we enjoy the benefits of compounding, and importantly, we also reduce and significantly reduce the trading costs. But in order for these portfolios to be income efficient, every security that we own, even if it is an equity, or especially when it's an equity and listed property, must pay a dividend or interest income. So there's always income being produced by this particular portfolio. As a result of that, the portfolio yields tend to be significantly above both the market and the peer group average. In fact, today, on both of our domestic multi-asset strategies, we are producing income yields that are significantly above what you get from most money market and income funds. The yields are around 6.5% to 7%. So your starting yield in a growth-oriented portfolio is actually higher today than what you would get in a typically riskless portfolio. And obviously, the prospect for long-term returns are far better in an income-efficient portfolio. And then importantly, from a retirement income planning perspective, the income produced by the portfolio grows at or above inflation in the medium and long term. Now, I've got a slide towards the end of the presentation where we look at some of the issues that these portfolios have faced, in the most recent past as a result of what's happened with COVID and lockdowns. But we've already started to move in the right direction, and we do anticipate very strong income growth over the medium and longer term from this particular position. So what you're looking for is an above average income yield, or this is the expectation that you and your clients should have, generating an above average income yield, inflation beating distribution growth. And because capital is a function of income through time, businesses become worth more as their cash flows or earnings improve and as their dividends improve. We also anticipate inflation beating capital growth on the back of that inflation beating distribution growth. So in a nutshell, the Payers and Growers investment philosophy is re-emphasizing the importance of income. If you look at the way that the returns are made up, particularly in a growth-oriented portfolio, you get a significant amount of volatility from capital. You do anticipate higher returns, but it's very difficult to predict with any degree of certainty what that return is likely to be. However, the income that is produced by a portfolio of growth assets is actually much more predictable and much more certain. Now, that predictability and certainty is extremely important for clients in the decumulation phase, but it is also very important while clients are accumulating for retirement, because you need some measure at any point in time of how much income your portfolio is likely to generate when you need to draw that income in retirement. And the reason why we want to focus on the income for retirees is because of the risks that these retirees face. The retiree needs to know that they are able to draw sufficient income on their retirement date in order to meet their existing lifestyle needs. And if you've got volatility, if you've got uncertainty, it becomes very difficult to make that decision. So having an income stream that is predictable and certain, and that starts with a fairly high base, you can avoid the risk of the sequence of returns not being in your favor. Because we are invested in growth assets, we're trying to overcome the inflation risk that retirees face. In retirement, most retirees find that their inflation is a lot higher than what the Stats SA will tell you, what the government tells you. And so in order to make sure that the annual drawdown that you're taking is maintaining your lifestyle, you need to ensure that the income is growing by at least inflation every year. And then we don't know how long each retiree is going to live in retirement, and so you need to make sure that you're generating high enough returns over long periods of time in order that the capital is never exhausted while in retirement. Now, this particular problem of constructing a retirement income plan has been described by Nobel laureates as the nastiest, hardest problem in finance. And there isn't any perfect solution, but we do feel that by focusing on income and income growth, you go a long way to satisfying or to at least alleviating many of the risks associated with retirement. And I think one of the reasons that people do have this particular issue is that they look at accumulation and decumulation as two distinct phases in a retiree's life. You have a lot of risk in the beginning, and then slowly you start to take the risk off, and then your returns start to diminish. And by the time you get to retirement, a lot of investors are undersaved, and then once you start retirement, you go even more riskless in terms of your approach. And again, the returns just become lower and lower. Yes, they are certain, they're predictable, but they're not high enough to last for 15 or 20 years. They're certainly not high enough to ensure that the client can draw an inflation hedged income every year. So, you know, there are a lot of common misconceptions around the whole retirement income plan, and part of the pay as and grows philosophy is to overcome these problems. And it's one of the issues that I will be describing in our workshops next week, where we'll be putting together a series of plans based on various allocations to our portfolios in order to see how they would work for a retiree, both in the accumulation and decumulation phase. Now, the concept of passive income in order to generate an income in retirement is certainly not a new concept. However, over time, it has slowly diminished in importance. You know, if you think about the two sources of return, capital and income, I've already described as capital. It's highly volatile, very unpredictable, very difficult to forecast, whereas income is obviously the complete opposite. But as we've moved into this low interest rate, low yield environment, the impact of income on overall total return for an investor has become very much less significant. And most portfolios today produce almost no income whatsoever. It's all about capital growth, meaning that the retirement income plan is increasingly becoming more difficult. I did mention earlier that I would show a slide in terms of some of the income issues that the portfolios have faced over the last 2 years as a result of the pandemic and the economic lockdowns that we've had. What we can see is that if we use 2019 as our base, you know, by 2020, we'd seen a 30 to 40% reduction in income. We've had a small increase in 2021, but we're forecasting a much more significant increase in 2022, and then inflation beating distribution growth in 2023. So basically taking about 2 years to recover to pre-pandemic levels, which I think is a great outcome, and it's testimony to the quality of businesses that we own in the pay as and grows portfolios. Importantly, you know, if you're blending, for example, this is the managed P&G fund, by the way. If you're blending the managed P&G fund with the global managed growth fund, you're going to get even more income, because as I've described, the global managed growth fund is now also paying distributions, albeit that they are quite small. So in conclusion, you know, what can investors expect from a pay as and grows portfolio? Well, you're going to have a high allocation to growth assets. We want to be in the market generating the highest possible returns over the longest possible time period. It does, however, mean that there will be increased price volatility, and there can be periods of underperformance against the peer group. We are producing significantly higher income yields than the peer group, and currently in our multi-asset strategies, that's between 2 and 3 times higher than the peer group average. We focus on both capital and income and growth in those two metrics over the longer term. It's not just about income, it's not just about capital. Yes, the income is important, because ultimately the income is going to derive the capital growth longer term. And as a result of these key outcomes, it can allow for better retirement income planning. With that, I'm going to hand over to our next presenter, Piet Viljoen. Thank you very much.
Thank you. Thank you, Ian. Right, so today I'm going to talk to you about the Counterpoint Value Fund, South African Value Fund. Within the value strategy at Counterpoint, we also manage a global value fund and a worldwide flexible fund, but today's focus is on the Counterpoint Value Fund. So basically the universe in which this fund invests is SA listed companies, domestic companies. So it does not hold any offshore listed assets like many of the larger asset gathering type firms. We think investors can make their own decision as to what the exposure they want to South Africa versus global. This fund gives you exposure to value South African companies, undervalued South African companies. So it invests specifically according to the value investment style, which means it buys companies which trade at a discount to the intrinsic value, and that discount is priced at a significant margin of safety. So that it's unashamedly value fund. very importantly, we focus strongly on risk management when we put together the fund. You'll see in the background of the slide there's a bundle of twigs, and that's how we view the construction of the portfolio as well. So we manage risk primarily through the tool of position sizing, and each asset or stock gets sized according to its risk, not according to its weight in some arbitrary index, but according to the risk faced by that specific stock. And that risk is measured along a couple of vectors. The first is how good a business is it? Is it a good quality business or is it a low quality business? Obviously, the higher quality the business is, the higher the weight can be, given a level of undervaluation. The second thing we look at is how popular a business or a company's equity is on the market. The more popular it is, the less of it will own, and the less popular it is, the more of it will own, for the simple reason that when something is very popular, it's widely owned, and when something bad happens, everybody tries to sell at the same time, and you get quite negative price volatility. So we try and reduce the position the more popular a stock gets, and vice versa. And the final risk vector we look at is just how the company is positioned in its own capital cycle or its industry's capital cycle. Is there a lot of supply coming into the market, or is there supply being taken out of the market? The less supply there is, the more of the stock will own, the less risky we think the position is. So very much a focus on risk management via the tool of position sizing. The other way in which we manage risk is by the composition of the portfolio. As I said earlier, we like to invest in higher quality businesses. So higher quality business, very simply defined as companies who have been able over the last 10 to 20 years have been able to generate earnings growth in excess of the average business on the Johannesburg Stock Exchange. Those are regarded as higher quality businesses. We tend to have at least 70% of the portfolio in those sort of companies. We also add to that three different strategies which we think are fairly uncorrelated. The first is spin-offs. We own a basket of spin-offs where a company gets spun off the mother company, and the investors tend to sell that company without regard to valuation. Interesting recent example was MultiChoice being spun out of Naspers. Naspers shareholders got these MultiChoice shares. They had no idea what this business was, bearing in mind that many of Naspers shareholders are overseas, and they sold the share down quite dramatically after the spin-off, which tends to happen with spin-offs, and that was a good time to acquire. Generally, we hold spin-offs around 3 years, and then we sell them. The second basket of uncorrelated opportunities, what we call net current asset value, stocks that trade below net current asset value, in other words, below liquidation value. And today in the South African market, there are quite a few companies that are priced as such. Great business such as Lewis, for instance, is trading below liquidation value. So we have a basket of those stocks. And the final basket is where we have the special situations, deep value situations. Recent examples where we made some money was something like Ascendus, PPC, Avenge, Steinhoff. Basically companies that are either in litigation with creditors, highly leveraged, where the equity sliver is very mispriced by the market because of uncertainty and fear and so on. And it is possible to make money through those special situations. So the fund is composed of different baskets of securities which are fairly uncorrelated, the returns to which are fairly uncorrelated. And the final thing we focus on very much is being able to invest across the market cap spectrum of the South African market. We think there are always good opportunities in small and mid-sized companies, and therefore over time we will limit the size of the fund. It's only 500 million rand at the moment, and we are not going to grow this fund into a 60 billion, 100 billion rand fund. We will limit the size of the fund because if we don't do that, then we will lose the ability to invest into some of the special situations and small caps where we have generated good returns in the past. And I'll just to show you how that works. This is the track record of the fund over the past 1, 3, and 5 years. You'll see it has significantly outperformed the all-share index over all periods. The interesting point here is that the average general equity fund has underperformed the all-share index over all periods. And that is because these average general equity funds are by and large dominated by the large funds of 50 to 100 billion rand. These funds have taken a significant portion of their investors' money offshore because the local market's too small for them. And also these funds cannot invest in local small and mid caps. So you can't get that exposure, and that also drags down the returns. The Counterpoint Fund can do so and does do so to its benefit, as you can see over time. And just to reiterate that that's the performance to the end of December. Just an update over the past month. It's a very short period, but it'll lead into my next slide, where I think there are changes happening in global markets, significant changes happening in global market. You can see the MSCI World in Rand was down almost 9% in January. Value outperforming that, being down just less than 5%, and growth underperforming that significantly, down 12%. During January, the Counterpoint Value Fund was up 5% versus the average general equity fund being up 0.8%. So South African assets have actually done very, very well during January, and we think there's a significant change afoot. And basically that change comes because we've experienced basically 2 generations of declining interest rates. The US Treasury yields peaked out in around 1980 at around 16%, the 10-year Treasury yield, and has declined to under 2% over the past 40 years. That's 2 generations of investors whose only experience is that of declining interest rates, and at the same time increasing valuations. Over the past 40 years, valuations, as expressed by the market cap of the S&P 500 relative to US GDP, has just gone up and up and up, in part driven by lower interest rates. As interest rates decline, the present value of future cash flows goes up as they're discounted by lower interest rates. But also what's been happening is that corporates have becoming, especially in Western and specifically in the US, are becoming more and more profitable. Their margins have been going up, and that's been driven by 3 factors. The first factor, of course, is the granting of China as most favored nation status by the US in and around 1980. That opened up trade with China, and China started exporting deflation to the rest of the world through their low cost of labor. The second thing that's happened since 1980 is the invention of the World Wide Web, the internet. That started in the early 80s, which has led to major efficiencies across all types of industries. And the third thing that's happened since 1980 is that commodity prices have been declining substantially as more and more supply came on stream. So that also helped the margins of businesses expand over time, lower input costs via both commodities and labor via China. But we think all 3 of those things are starting to end. The following chart shows the price of commodities, the Goldman Sachs Commodity Index total return relative to the S&P 500, and you can see that chart peaked around about 1990. Commodities were high relative to stocks, and apart from a short burst around about 2003 to the global financial crisis of 2008, commodities relative to equity has been declining consistently. But we think there's a change afoot, and that's driven by 2 factors. First, on the demand side, we think that global energy infrastructure will create a lot of demand for commodity investment as we fight climate change by going green in terms of our energy requirements. Batteries, transmission infrastructure, and so on, will require a lot of capital spend. And of course, the whole Build Back Better movement, the post-COVID movement to create better infrastructure globally. I think those 2 things will drive demand, but more importantly, from a commodity cycle point of view, supply is being cut back through the ESG factors. It's very difficult these days to start a mine. It's very difficult these days to expand a mine, to get permissions to do so. And after the glut caused by the boom in commodity prices in 2005 to 2008, that glut ended around 2015, 2016. Mining and energy companies have been loath to spend any capex on expansion. And when they have wanted to do so, they've been stopped by the ESG and political lobby. So we think the supply of commodities, of various types of commodities, will be declining right into the teeth of expanding demand going forward. So that is what creates the cycle that you see in front of you, is the supply either expanding or contracting, and we think supply will contract significantly over the next 10 years. That has very important implications. First of all, we think higher commodity prices favors value investing strategies over growth investing strategies. We think it favors emerging markets over developed markets. And within emerging markets, we think it favors commodity-orientated markets like Russia, like South Africa, like Chile, Colombia, some of the Southern American markets, over possibly the more trading-orientated Asian markets. And within those sort of emerging markets, South Africa is probably one of the cheapest markets out there. So we think value investing in South Africa has quite a bright future, not just for the next month or 6 or 12, but for a longer term secular point of view. And so I'm speaking 8 to 10 years going forward. So what does the fund look like today? The top 10 holdings, you'll see there's a broad spread of financials, resources, even defensives, tobacco and AB InBev, telecoms, NTN Group. So it's well diversified, with a common denominator. These stocks are all trading well below the intrinsic value. Something like MTN has gone up, has tripled over the past year. It's probably trading close to intrinsic value. We have been reducing our weight of MTN into that uptick because it's just not as cheap as it was. But other companies remain extremely cheap, specifically our banks. I think the point to highlight about the fund is just how it is positioned in terms of market capitalization, very overweight the small and mid-cap stocks and underweight the large cap stocks, because it can. It's small enough to be able to do so, because within the market, we think the best value is in South African industrials, financials, and energy stocks. Those are the most undervalued sectors. That's where the small and mid-cap local companies sit, and those companies the fund can access because of its size. Of course, the fund has to be underweight as a result of that overweight positioning in other sectors, and the biggest, of course, is consumer discretionary, where it's underweight Chinese exposure via Naspers, major underweight there. And you'll also note that it's underweight the material sector, although it has quite a high exposure to material sector, almost 30%. Material is now almost 40% of the All Share Index, which is quite concentrated and quite high. So from a diversification point of view, we're not fully there. So that's what the fund looks like at this point in time. Just 2 examples, and I think these examples are interesting for a number of reasons. The first value-laden example is Sasol, which has increased from a share price of 40 Rand during 2020 to a current share price of over 350 Rand. The value fund started buying around 100 to 150 Rand. Once it was clear that the debt situation would not pull it under, because there was one point when the equity could have been worthless due to the massive debt situation in Sasol. But we think, given the current oil price, and we are still very optimistic on the future for oil and energy prices generally, but given the current oil price and the current Rand exchange rate, Sasol is on track to earn around 80 or 90 Rand in the year to June 2022, which puts on a PE multiple of around about 4 at its current price of 360 Rand. And that just is ridiculously cheap. It'll also start paying dividends sooner than expected, and we can expect quite a fat dividend out of Sasol going forward. And Sasol is a large cap. You would have noted it as one of the top 10 holdings in the fund because of its large size, because of the historical ability to generate good earnings growth. Another holding which has contributed to good returns from the fund over the past few months is Rebosis, small cap, tiny market capitalization, highly discounted during 2021. The value fund was able to build a nice position around 75 cents a share. And then they announced that they had done a transaction where they sold half their portfolio at NAV. And NAV for Rebosis is around R4.50 a share. You can see it was trading at 75 cents a share at a big discount to NAV. So if this transaction happens, it's not clear it's not clear yet whether it will happen. If it happens, there could even be further upside to the share. But a small cap original position size was only 70 basis points, but that's gone up since then because of the share price movement. And that also illustrates how we deal with different types of situations, undervalued situations, where we have a large cap, good quality business like Sasol will take a much bigger initial position than a small cap, low quality business like Rebosis. But those are two examples, two of many examples of value laden situations in the South African market. So to summarize, the investment conclusion, when we talk about the South African Counterpoint South African Value Fund, it's a bundle of twigs. It's a bundle of interesting undervalued situations. Each one individually is fragile and might not do well. I mean, there's still a chance that Rebosis doesn't do well if the transaction doesn't go through. But if you take each one of the little twigs and you bundle them up, and tie that tightly together, you come up with a strong portfolio. And that's what we're trying to do here. So the takeaway for me here is that we think South Africa is still cheap enough to include in a diversified global portfolio. And whatever your neutral weight of South African assets is, I think one should have a higher than neutral weight because of its cheapness in a global environment. It's highly attractive. So even if your neutral weight is 0 in South Africa, maybe you want to look at a 5 or a 10% position in South African assets via the Counterpoint Global Value Fund. And within South Africa, we still think, despite the good performance of the fund over the past year, there are still very attractive value opportunities available. Companies like Lewis, I haven't even spoken about Lewis, is trading at below liquidation value for a business that probably out of all the retail companies gave the best trading update over the past month. It's a well-managed business trading at below liquidation value, and there are quite a few situations like that still around. And finally, the fund size is a definite advantage. We can invest in special situations. We can invest in liquidation valuations. We can invest across the market cap spectrum because of the fund size, and the fund size will be limited at a certain level to be determined in future. So with that, I'd just like to say thank you very much for your time today. I know it was a long session, but thank you for sticking around to listen to me as well. And I'm going to hand you back to Jaco for some final words.
Thank you, Piet, and thank you for your contribution. And just from my side, a big congratulations on the award that you won. And we're very happy for you and also very proud to have you part of the Counterpoint team. So just to wrap up, guys, thank you so much for your time that you've given us this morning. As Ian mentioned earlier, we will have the Payers and Growers workshops next week. We will follow that up on a monthly basis. During March, we will have workshops or webinars on the value franchise. We will also have the similar kind of sessions for quality during April, the fixed income franchise during May, and then the quantamental during the month of June. I would just like to remind and ask, or request rather, that you do take a minute just to complete the survey when you log out of the session. And then, yeah, if you need anything from Counterpoint, if there's anything that you'd like to query, please reach out to us at info@cpam.co.za. And then once again, thank you for your time. We really appreciate it. We wish you a wonderful day and a successful 2022. Until next time. Thank you. Bye-bye.